In today's discussion, we'll delve into the vast landscape of illicit financial activities, exploring not just billions but trillions of dollars involved in illegal shorts. What's even more intriguing is the colossal sum tied up in failure to deliver FTD within a particular financial instrument that none other than Ken Griffin himself is actively shorting. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But everyone remember, this is not a financial advice video.
A recent tweet by Kristen Shaughnessy shed light on the alarming trillions in settlement fails, and regulators are nervously watching, hoping that the situation won't unravel on their watch.
The financial markets are teeming with trillions of dollars entangled in both FTDs and illegal shorts, creating a ticking time bomb that, once triggered, could potentially implode the entire system, a catastrophe the current regulators are desperately trying to avoid, as reported by Kristen Shaughnessy. To grasp the magnitude of the fraudulent threat looming over our financial markets, refer to Brian James Barclay's in-depth investigation. This investigation unveils the unsettling truth about settlement fails and FTDs in Europe, exposing the inadequacy of rules surrounding naked short selling and trading transparency. Both us and European regulators turn a blind eye to European-based hedge funds illegally shorting us companies without the obligation to disclose short positions, FTDs, or illegal shorts. Peruvian Bull has also highlighted a significant event involving the 10-year Treasury note back in May 2003, which experienced a record-breaking $162 trillion in fails in a single day. Astonishingly, hedge funds led by Ken Griffin are currently shorting the same Treasury note with an unprecedented position, surpassing their shorts from 2003. Throughout 2023, the 10-year Treasury note fluctuated, causing substantial losses for short sellers. Although it dipped briefly, January saw a resurgence, challenging the hedge funds once again. The historical context of the 625% 13th of May Treasury note failing in 23 sheds light on the gravity of the situation. The web of fails reached an astronomical $62 trillion, reshaping the landscape of fails and the repo market.
It's crucial to remember that Ken Griffin is presently shorting this very same Treasury note in the current market climate.
Additionally, AMC Biggums delves deeper into the settlement fails and FTDs in Europe. Euroclear Bank and Clearstream Banking SA reported staggering amounts €183 trillion and €576 trillion, respectively, in settlement fails in 2022. While this cumulative FTD value across a year is technically not supposed to be aggregated, even a daily breakdown reveals an alarming average of nearly 2 trillion FTDs per bank every day. This underscores how European banks and hedge funds are inadvertently aiding us hedge funds in shorting us securities. Now, let's explore why the tables may soon turn and why we might witness a squeeze in AMC, causing these hedge funds to face imminent challenges. The Daily Shot recently highlighted that the put-call ratio is at an all-time low, signaling potential trouble for stock investors. This ratio, indicating the ratio of short positions to long positions compared to the Nasdaq, is currently at its highest in the past 20 years. As seen in historical patterns, an abundance of put options compared to call options has historically preceded unfavorable outcomes for stock investors. This aligns with the fact that hedge funds are currently heavily shorting the stock market, a risky move that could lead to substantial losses if the market continues its upward trajectory. The CEO of Verdue, Doug Sifu, seems to be banking on a specific outcome. He expresses a preference for Hester Peirce to take over the role as the head of the SEC over Gary Gensler. The rationale behind this preference lies in the hope that Peirce would continue to overlook FTDs synthetic shorts and provide leeway for hedge funds and market makers to sidestep margin calls. This strategy was successful in 2021 for Robinhood, and it seems larger market makers may require similar leniency. While the SEC can waive margin calls, it cannot prevent outright collapses and bankruptcies. The financial landscape is complex, and even with regulatory interventions, collapses similar to the 2008 recession or the dot-com bubble burst of 2000 are inevitable. Large companies like Google, Citibank, BlackRock, and Amazon announcing mass layoffs signal a turbulent path ahead. An article further elaborates on the expectation of witnessing more mass layoffs in 2024. As interest rates remain high for an extended period, companies, particularly those experiencing their worst quarters in a decade like Citigroup, are anticipated to implement more layoffs. This situation is exacerbated by the fact that interest rates are not expected to be cut during upcoming FOMC meetings. The prospect of prolonged high interest rates paints a grim picture for companies already struggling, predicting more layoffs and collapses in the coming year. In conclusion, the financial markets are grappling with not only astronomical amounts in illegal shorts and FTDs, but also facing challenges from historical market patterns and economic indicators. The intricate interplay of regulatory decisions, market dynamics, and global economic conditions sets the stage for a potential upheaval in the financial world. As we navigate these complexities, it remains to be seen how the various factors will converge and shape the future of our financial markets. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.